The spot market is where spot trading happens. Spot markets are available not only for cryptocurrencies but also for stocks, foreign exchange, commodities, and bonds, among other asset types. In this video, we will discuss crypto spot trading and margin trading and what is the difference between them. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So, watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So, let's begin the video. The spot market is where traders purchase and sell assets, in the case of cryptocurrencies, tokens, at the going rate for delivery right away or very soon, within a few days. The term spot refers to the process of transacting and accepting ownership of an asset immediately. The spot price, trade date, and settlement date are the three crucial ideas in spot trading. Spot price. The price at which a spot deal is carried out is the spot price, which is the asset's current market value. By publishing their buy or sell orders, which include the price and quantity at which they desire to transact, buyers and sellers establish the spot price. As new orders are placed and old ones are filled, the spot price changes. Trade date. The trade order is carried out in the market on this day. In essence, it begins and records the transaction. Settlement date. The assets involved in the transaction are actually transferred on the settlement date, also known as the spot date. Depending on the type of market being traded, the interval between the trade date and settlement date may be on the same day, for some money market assets, for example, or a few days, typically 2 days for stocks. For cryptocurrency, it usually happens on the same day, though it may differ amongst exchanges or trading platforms. Spot trading is immediate, thus a trader needs to have the whole amount available to cover the trade. To acquire $1,000 worth of Bitcoin, for instance, a trader must have the full $1,000 in their account, otherwise, the exchange or trading platform won't perform the trade. What is crypto margin trading? Margin trading is the practice of funding a deal with borrowed money. Therefore, the primary distinction between margin trading and spot trading is that the former enables the trader to open a position without having to cover the entire cost out of their own pocket. Leverage, margin, collateral, and liquidation are the crucial terms to comprehend in margin trading. Leverage. This refers to using borrowed money to complete a transaction. For instance, if a trader wants to purchase $1,000 worth of Ethereum, ETH, at a leverage factor of 5x, or multiple of 5, they will only need to put down $200, with the remaining $800 coming from the exchange or trading platform. To put it another way, the trader took out a loan to multiply their position by 5. Equity is the worth of the account balance calculated using the current market price less the borrowed amount. Varying exchanges and trading systems have different maximum leverage limits. Margin. The equity level fluctuates in real time along with an asset's market price. The trader will receive a margin call if the equity level falls below a certain level, also known as the margin requirement, which is set by the exchange or trading platform. In order to raise the equity value back up to the level where margin is required, they must then sell part or all of their position and/or add more of their own money to the account. Collateral and liquidation. When a trader applies for a loan, the assets in their account serve as collateral. The exchange or trading platform may sell the assets in the trader's account, a process known as liquidation, and use the proceeds to settle the loan if the trader fails to meet a margin call. If you are still watching this video, Don't forget to hit the like button and share your thoughts in the comment section below. If you haven't subscribed to the channel yet, please subscribe, as that motivates us to bring more videos like this for you. Crypto spot trading, pros and cons. The key advantages of spot trading versus margin trading are that it is less complicated and does not have the potential to magnify losses. Because a trader doesn't have to worry about things like margin calls and determining how much leverage to utilize, it is simpler. The trader does not run the risk of having to contribute more of their own money or of losing more money than they already have in their account because there are no margin calls. The fundamental drawback of spot trading is that it is not able to take advantage of any potential return amplification that leverage might provide. Crypto margin trading, pros and cons. The primary benefit of margin trading is the possibility of multiplying profitable returns when employing leverage. Let's look at an example where a trader purchased 1 Ethereum, ETH, for $1,000 at a cost of $1,000, and then the price increased by 10% to $1,100. Assume that in the leverage scenario, the trader employed a 5x leverage ratio, using $200 of their own money and borrowing the remaining $800. When employing leverage, the return is 50%, which is higher than when using no leverage, which is 10%. Leverage, however, has a double-edged nature in that it can both enhance good and negative returns. Let's suppose that the price of ETH decreased by 10% to $900 as opposed to increasing. In comparison to the return of -10% while employing no leverage, the return of -50% when utilizing leverage is much lower. The potential for receiving margin calls is the other significant drawback of margin trading. This can require the trader to risk losing more than what they initially invested by adding more of their own money to the account, as previously mentioned. Cross-margin enables the trader to distribute margin balances among other positions, allowing excess margin, i.e., equity beyond the minimum margin need, from one position to make up for margin shortfall from another. The margin that is assigned to a single position and cannot be shared with other positions is known as an isolated margin. We will be posting another video on cross-margin and isolated margin very soon. Spot or margin, how do you choose? Two popular trading methods are spot trading and margin trading, which are used in markets besides cryptocurrency, such as equities, currencies, commodities, and bonds. The decision is greatly influenced by the risk tolerance and circumstances of the trader. The main distinction is that spot trading doesn't involve leverage, but margin trading does. Risk and reward frequently go hand in hand, thus margin trading may be a choice for people who are willing and able to accept more risk in exchange for the opportunity of potentially higher gains. Spot trading could be less hazardous and easier to execute for more traditional traders. Please share your thoughts in the comment section below to let us know. See you in the next video. Until then, take care and stay fit in health and wealth.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.